Hello, and this is Module 1, and we're in Topic 3 now, and we're looking at the rewards of being a shareholder. So remember, there are 6 topics in this module, so we've got 3 more after this one. Let's get started. We're going to have a look at capital profit, because let's face it, if you're going to be taking your money and giving it to a company to buy a stake in that company, to buy shares, you're investing, and you obviously want a return on that investment. So we know that share prices go up and share prices go down. So how would you actually know if you're making a capital profit or a capital loss? The mathematics is actually much simpler than you could have ever imagined. So let's have a look at the formula for calculating capital profit. It's basically the selling price of the share minus the buying price, and that gives you the capital profit. Could it be simpler? I don't think so. So let's say, for example, you bought the share for 10 Rand, and then it's now trading at 50 Rand. So the selling price is 50, the buying price is 10, because you bought it at 10. 50 minus 10 is equal to 40, so you make a capital profit of 40 Rands. Now, because you can't predict the movement of the share market, you could also make a capital loss, and that's when the selling price then becomes less than the buying price. So for instance, if you had bought the share for 10 Rands, but then later on you could only sell it for 2 Rands, you would make a capital loss of 8 Rands. Very simple, basic arithmetic. Let's look at the next one. So when you look at capital profit, you might want to also look at it in percentage format and looking at the percentage return. So if you take the capital profit that we just calculated, which is the selling price minus the buying price, and you divide that by your buying price, it gives you the percentage return. So basically, if you want to see what return you're getting on your investment in a percentage format, that's how you calculate it. Your capital profit divided by your buying price. Simple, easy, straightforward. Okay, let's look at some more. Now we're looking at dividends. So what are dividends? Okay, so if you own shares in a company, dividends is basically when you get to participate in the earnings of the company. So you've bought a stake in a company, and when you earn dividends, it's when you get a piece of their profits. And when we talk about profits here, we talk about the company's net income. So net income is basically the profit that remains after the company has paid all its bills, all its wages and salaries and lights and water and everything that you can imagine. What remains is the net profit. And the net profit is what the dividends come out of. So that's actually your piece of the pie. So a company would have a dividend policy, and that dividend policy determines whether or not they do pay a dividend, because just because a company issues shares, it doesn't mean that they will pay a dividend, because sometimes when a company makes a profit, they prefer to take that profit and reinvest it in the business to grow the business. But then they can have a dividend policy where they say that, fine, they'll be paying out dividends, and that dividend policy would determine how frequently a dividend is paid out. So a dividend can be paid out once a year or even more frequently than that, and it would also determine the size of the dividend that gets paid out. Now, dividends are paid on a per share basis. So if a company declares that they're going to be paying a dividend of 1 Rand per share, it means that for every share that you hold, you'll be earning 1 Rand. So if you're holding 20 shares and the company declares a dividend of 1 Rand, it means then you'll be getting 20 Rands, because it's 1 Rand for every 20 shares. And if you own 1 million shares in the company and they declare a dividend of 1 Rand, then you'll be getting 1 million Rand in dividends. Wouldn't that be wonderful? Okay, so let's look at some ratios regarding dividends, because dividends are quite important when you're investing in shares. Let's look at the dividend payout ratio. Okay, so the dividend payout ratio is when you take the dividend divided by the net income. That gives you your dividend payout ratio. So that basically gives you your dividend as a percentage of the net income. So it allows you to see what percentage of the net income is that dividend that you're earning. And as an investor, if investors tend to not look favorably on companies that reduce dividends over time, because if you look at this equation, if you reduce your dividend, then it means your dividend payout ratio is going to get smaller. So what investors would tend to look for is a company with an increasing dividend payout ratio. And then we look at dividend yield. Okay, so the dividend yield is when you take your annual dividend divided by the share price. So that basically gives you an idea of your return, because basically the dividend is what you get as an investor relative to the share price, and that is called the dividend yield. So you can think of it as your return on investment, because you're investing in these shares. So looking at the dividend yield gives you a way to calculate your return on that investment in that particular share. So as you can see, the mathematics is very simple, it's basic, very easy to calculate. And if you tune into these modules, in module 5, we're actually going to look at understanding financial statements. And then you'll actually be able to see where you can get all of these pieces of information about dividends and the net income and the profits from the financial statements. It's actually very easy once you know what you're looking for, because you'll know exactly where to find it. So, fine. Companies pay out dividends, but when do they pay out dividends? So we're going to look at some terminology that will explain and make this clearer. So if we look at the slide over here, we've got terms like the financial year end, the results announcement, ex-dividend date, the record date, and the payment date. So a company works on a financial year. So a financial year is not necessarily in line with a calendar year. A calendar year obviously starts from January to December, but a company could look at its financial year from, say, March to February of the following year. It's their financial year. So a company would then have a financial year end, which is not necessarily December of that year, but the date that they choose as their financial year end. And they would have a results announcement. So that's the date on which they announce their year-end results, basically how the company has performed during that particular financial year. And then you've got the ex-dividend date. So how does that relate to the results announcement? If you buy a share that pays dividends, as a shareholder, you're entitled to earn a dividend, right? But now, after a company announces its results and says, okay, fine, we had a great year and we've made lots and lots of profits and we're paying a dividend of 1 Rand per share. So that's the results that get announced. You could still, as an investor, buy a share and earn a dividend. However, there is a cutoff time, which is the ex-dividend date. So if you want to earn a dividend on a share, you need to buy the share before the ex-dividend date, because from the ex-dividend date, any shares that are traded, the shareholder will not earn the dividend that would have been announced during those results of that financial year. And the record date is basically when the company then looks into the records to see who are the new shareholders. So as you know, shares get traded. So just because you buy a share today, it doesn't mean you'll hold it till the day that you die. You might want to sell the share again. So that's called trading. You'd want to trade the share again. So if you buy a share today and then you sell it to another investor, if that investor buys that share after the ex-dividend date, they won't get that dividend that was announced. And then obviously the payment date, very self-explanatory, that's the date which the dividend gets paid. So let's look at some dates to try and clarify this. So let's say, for example, a company has a year end in June. So 30th of June is their financial year end. On the 15th of August, they then announce their results to say how much profit they've made and whether or not they'll be paying a dividend, and if they are going to be paying a dividend, how big that dividend is going to be. And the ex-dividend date is the 30th of August. So if you want to trade shares, if you want to buy that share and still earn the dividend, you'd need to do it before the 30th of August. Otherwise, if you buy the share after the 30th of August, you don't qualify to get that dividend. And something also to bear in mind is that when you buy a share, it doesn't automatically or instantly get transferred into your name. So there's a settlement period that happens, and it's usually 5 days, 5 business days. So when you look at the ex-dividend date, you actually need to bear that in mind, that you actually need to trade that share, bearing in mind that 5 business day settlement period if you still want to earn the dividend. And then the record date of the company could be the 1st of September, and that's when they have a look at the updated list of shareholders who will then be entitled to receive that dividend. And then the payment date, 15th of October, would be when this dividend gets paid to all the different shareholders. So in all our discussions so far on shares and capital profit and what you can make from shares and dividends, we haven't looked at 2 important factors which actually drain what you make in terms of your profits. You can think of it as a leaking tap. So you've got profits that you make from your investments, but then there are leakages, and those leakages are basically taxes and trading costs. Yes, to buy and sell shares, there are trading costs, which are basically transaction costs. And then there are also taxes which are applicable. So we're not going to be covering taxes and trading costs in this particular module, but it's something to bear in mind and to consider that, you know, whatever profit that you do make, don't just focus on that particular profit figure. Also bear in mind and factor in the trading costs and the tax implications. And then you'll calculate your actual profit. And that brings us to the end of this topic. The next topic in Module 1 is Topic 4, and that is making your money grow. So definitely tune into that one. Thank you.